you go, hey, that was the bottom. And if we had a time machine, it would be awesome. But we don't have a time machine, so you kind of just got to go with
still no time machines.
No time machines, unfortunately. But that's true though, right? Everybody always wants to look back in hindsight and go, oh, this was the bottom. But at the time, you just don't know, and you can't predict it.
I think another segue there, another common question, and this goes into trying to time the markets. A common question that I'll get to is, I've been kind of parked on the sideline with some cash. I've had this over here at the bank. I know rates are better here. Is this really a good time to be buying? What are bonds doing? Should I enter that market now? And I'll let you guys offer your opinion. But I was going to mention, when it comes to the bond market as well, because I've had clients say, well, shouldn't we wait till after the government raises their rates? We've spent a lot of time talking about how markets are leading indicators, and the bond market is the same. Jerome Powell over at the Fed, he's done exactly what he said he's going to do so far every single time this year with no stray. And he's laid out, we're all expecting a 50 basis point hike at the end of this year and 25 basis point to start the new year. That has already been baked into the cake. So what would cause rates to go up more than that is obviously a change in news, change in inflation, or his speak would be different. And so it's unlikely, if he does exactly what he said he's going to do, it's unlikely that rates should go that much higher from where we see right now, at least on the longer end of the curve. And so I've been telling folks, if you're sitting in cash, bonds are starting to look more attractive right now. The rates are much higher than they were a year ago.
So Jason, why are bonds starting to look more attractive? Just so everyone understands.
Thank you. Yeah. So what has happened here, like the very first slide, I think Kyle showed the worst bond market in the year prior to this year. I think the bond market dropped 4% to start this year. Kyle, what did your slide say to start the year? Down 16.
Well, it's been as high as 16, but through there it was 14.9, I believe, on that one. But it's been as low as 16 on the ag.
And I think the ag is down 14 right now.
So the sell-off that we've seen this year in the bond market is about 4 times worse than the previous worst. And so you want to talk about buying low. The bond market, for a little more explanation for folks, the reason why the bond funds that they own are down is not because of the quality of the stuff inside. In many of the cases in a lot of the bonds that we own, they're investment grade, or what we would call top tier types of bonds or debts inside that from the federal government or from AAA rated companies like Microsoft and Johnson & Johnson and Apple Computer. None of these outfits have had any trouble making their bond payments. The reason why this has come down so much is because the newer, shinier rate is that much higher, because the rates have come up so dramatically on the outside that if we're buying a brand new bond that would pay more, it's more attractive to them. So the older stuff has to come down in price to kind of equalize out. And so now what we're looking at with these yields on a lot of these bond funds, an investment grade bond fund a year ago was paying less than 2%, and now it's paying over 4%. And this is the same bonds. And so now those yields, those dividends that are coming out of these funds are beginning to look quite attractive for longer term money, just to kind of let it reoccur and park and earn interest. The other thing, go ahead.
I was going to say, and if you think that rates are, kind of topped out, we've talked about maybe another 50 basis point hike in 25, maybe in 23, but eventually rates probably will go back down. Again, just looking at historical, how things have worked, if we go into a recession, they'll need to probably cut rates. And if you cut rates, then your bonds that have the higher coupon rate actually look more attractive than the new bonds. And that actually increases bond prices. So,
that slide highlighted that too, Adam. If you look at that same slide, that down 14.6. If you look at the next 12 months following that, for the most part, we've had pretty positive returns in the bond market, and it's because usually it's the raising the interest rates that kind of sets that bottom floor of the performance for the bonds, and then eventually they do have to start cutting rates. They don't ever keep them up as high as they were. So.
Last point I'll mention on cash, if I'm going to try to pull up that slide that I had on recessions that showed the 6 months before, because the point that I'll make there is, if we had Warren Buffett on this call with us right now, he wouldn't be able to tell us what's going to happen over the next 6 months. We don't know. No one knows that short of a time window. But if you start looking here 1 year, 3 years, 5 years, 10 years out, very few of our clients need all their money back in the next 12 months. Even if they're retired, they're going to need a little bit of money, but they're not going to need it all. And so if I'm sitting on a big pot of cash, I've got money at the bank, I'm just kind of nervous about what's going on. what I've been advising people to do is just to begin dollar cost averaging. We don't know if the bottom of the market is behind us in October, or if it's going to be ahead of us, but it's likely to be close to us. And so I would begin dollar cost averaging and just kind of getting that cash to work, because every indicator we've got, whether it's in bonds or stocks, once we look out 12 to 24 months, when you've hit these big massive lows, very rarely is the market still down.
What about people contributing to corporate retirement plans, 401ks and things like that? Where does your guidance go there?
That's a good point too. Let me back up. You've got some people that are holding off on adding to their retirement account because they're nervous. I would definitely advise them against that. But then another thing to consider starting into the new year, because now we're finishing up the year, they're most likely maxing out their plans if they can. But then as you start into January, one tactic that one could take upon themselves, rather than if they add money to their 401k every single month throughout the year, if they can afford it, one strategy might even be front loading it and piling in their savings for 2023 all into the first quarter. That could be a way to take advantage of the correction in the market.
For sure. Yeah, I think to the cash question, I mean, the answer always is how much time do you have, right? And you kind of alluded to that with Warren Buffett. Like, if somebody says it's a good time to invest cash, the first question is, well, how much time do you have? 6 months? I don't know. I don't know if it's a good time to invest cash. I mean, I wouldn't take too much risk because we don't know. But like your chart showed, if you're talking,
when you say hold on, when you say invest cash, you mean put it into equities and longer term bonds.
Yeah, sorry, I didn't mean invest in money market. Invest cash into a diversified portfolio with some risk to it. But again, as you look over time, I pretty much tell people it's always a good time to invest cash if you have the right time horizon. Mm-hmm. If you have the proper time horizon, which for us, we pretty much tell everybody, if you don't have 5 to 7 years, you probably should be reconsidering investing in a true diversified, portfolio with some real risk in it, with some equities. If you're talking about bond portfolio, stock and bond portfolio. If you're talking about, hey, I want to shift my bank deposit to money market, well then, you don't need 5 to 7 years for that. But your average, your typical Strong Valley client that's looking for, real investment return over a long period of time, and wants an advisor to spend 15, 20 years with them. Again, you're nickel and diming with which day to get in, because one of the things I've heard recently I think is great is about market bottoms, and it's so true. I mean, everybody's waiting for the market bottom, but when we'll know when the market bottom is? About 6 months after the market bottom. Mm-hmm. That's when we'll know. You go, hey, that was the bottom. And if we had a time machine, it would be awesome. But we don't have a time machine, so you kind of just got to go with
still no time machines.
No time machines, unfortunately. But that's true though, right? Everybody always wants to look back in hindsight and go, "Oh, this was the bottom." But at the time, you just don't know, and you can't predict it.
Yep, agreed.
Other cash thoughts? Good time for cash. Good time for bonds.
I think we've hit it on it. I think it depends, one, like you said, timeline, but two, we're seeing higher interest rate on the short-term stuff now. So money that's sitting there that you don't need today, if you're willing to take a little bit of risk on it, even our short-term corporate bonds are even paying us, pretty good interest rates now that we weren't seeing 6 months ago. So it's definitely worth looking into depending on your situation.